from stock investing, money management strategies, and to sharing from our local religious scholars, I'm sure you will return home today enlightened and fulfilled to embark on the next step of your personal finance journey. Next up, I'd like to give a big shout out to the organizing team, partners, and volunteers from Madrasa Al Junaid Al Islamiyah who have been so generous with their time and resources to make this event possible. Before I move on, let me just share a few housekeeping rules. Firstly, please switch your mobile phones to silent mode in this hall during presentations. Number two, if you have questions for our speakers, please use the sliding QR code that will be flashed on the screen to submit them. Alternatively, you can use the microphone that we prepared to ask them in person. Next, if you ever need to answer nature's call, please feel free to proceed to the washrooms outside at any time. And lastly, as much as possible, please maintain the cleanliness of this event space. Please dispose your trash properly, be careful to not spill any food and drinks during lunchtime, and last but not least, just have fun and ask questions if you have any. Okay, now that we are done with the SOPs, let's take a look at what we have in line for us today. We'll start with the Fund Manager's Guide to Stock Investing, a workshop conducted by a seasoned portfolio manager who will be sharing practical technical tips for you to start your stock investing journey. We will then have our guest of honors address, followed by our second segment, a fireside chat on navigating rising costs of living and upholding community values. At midday, we'll take a nice break for lunch, networking, and to do our Zoho prayers. Here, I strongly encourage all of you to visit all the booths that we have at the back of the hall and learn about the Sharia compliant options available. Our friends at the booths are very friendly, don't worry, you and bright, and they are happy to share and answer any questions that you may have on the products. We'll then return from lunch for an exciting mini workshop on smart money management. Afterwards, we'll continue to a presentation and panel discussion on exciting developments in the Islamic finance industry. Now, after all that information during the presentations, our brain's going to take a break, right? So don't worry, we'll have a short one after that before proceeding to the last segment of the day, which are the launch of a Sharia compliance certification for one of our most valuable partners, and the final panel discussion by our esteemed asatizahs. So without further ado, let's kickstart the day with our very first session, the Fund Manager's Guide to Stock Investing. And with that, allow me to introduce to you our speaker, Ishrat Hassan. Ishrat Hassan is the Head of Research and Portfolio Manager at Fard Asset Management Singapore, where he manages a global equity fund, Asia ex Japan fund, and Sharia equity fund. Prior to Ford, he worked as an investment analyst for Lecter, a multi-billion-dollar family office based in Dubai, and a boutique investment bank Houlihan Lokey based in New York and London. Ishrat graduated as a university scholar from the Wharton School at the University of Pennsylvania. With that, everyone, let's give it up for Ishrat Hassan.
Bismillahir Rahmanir Rahim. Innal hamdalillah nahmaduhu wa nasta'inuhu may yahdihillahu fala mudilla lahu wa may yudlilillahu fala hadiya lahu wa ashhadu an la ilaha illallah wahdahu la sharika lahu wa ashhadu anna Muhammadan abduhu wa rasuluhu. Amma ba'd. Assalamu alaikum wa rahmatullahi wa barakatuh, everyone. How are you all doing today? Alhamdulillah. I know it's early on a Saturday morning, and I commend you all for coming out here to learn, grow, and support our friends at IFSG and the Muslim community here in Singapore. Alhamdulillah. May Allah subhanahu wa ta'ala put barakah in your lives, illuminate your pathways to rizq, and make this event beneficial for you all, inshallah. So when Ridwan first asked me about this talk, I was wondering how best to distill the complex quote-unquote art of stock picking into a 1-hour session to at least get you started on the right path, inshallah. When I say art, because it's definitely more of an art than a science. I thought about all the teachers I learned from and what were the key takeaways from them. Over my career, I've worked with some of the most successful investors of our time. My old boss, Christopher Chandler, sold his mother's department store in New Zealand for $10 million and compounded that capital at more than 30% for 30 years. So he took 10 million and made that into $5 billion when I joined him in 2010. My current boss, Dave Ford, did something very similar, but compounding at a slightly lower pace at around 15% for his 40-year career. But when I dug deep and thought about who I learned the most from about investing in the stock market, there was only one person that clearly stood out above both these giants. Who do you think this is? I mean, some people ask me if it's Warren Buffett. I mean, I have learned a lot from people like him, Peter Lynch, Philip Fisher, and so on. But the person I learned the most from about identifying good businesses and most importantly, valuing them was my mother, alhamdulillah. May Allah have mercy on her and bless her. Maybe the next slide, please. So this is her in this photo. Please make dua for her, inshallah. So my mother was a very resourceful woman. She didn't know head or tail about finance or even investing, but she was a natural master of value investing, or should I say value purchasing. I have no doubt that had she had the same education, opportunities and circumstances that I had, she would have been one of the best investors in the world. So let me tell you a bit of her story and how it relates to picking stocks. When my brother and I were growing up in Sri Lanka in the 90s, we didn't have much money. There was lots of uncertainty because the country was also in the middle of a big civil war. Now, my father was a lawyer, which usually meant that you were very rich, but not in his case, unfortunately. He was, I would say, the country's or maybe even the world's only free lawyer, which meant he didn't charge anything of anyone for his services. Whenever anyone came to him for work, he would undertake it with great care and diligence, and when it came to payment, he would always say that anything was okay. And he really meant it, you know. Most of the time he would service people for free, but sometimes he would get paid in bananas or bread or a few hundred rupees, you know, which amounted to a couple dollars today. Now you can imagine that given this business model, he had clients come to him from far and wide, and he would expect nothing in return for his service. His belief in Allah was so strong that if he did his best, that Allah would take care of him and his family. And the only thing that both him and my mother wanted from this dunya was for their two sons to be educated. My mom, on the other hand, was very different. I mean, she also had great iman, but she knew that if we didn't have enough, there was no way that her kids would be able to afford the education that she wanted for them. Because the universities in Sri Lanka were not so great, and the country was also suffering. So she wanted her kids to have a better life abroad, to go to the United States where my uncle was, and to study in the best universities in the world, which of course didn't come cheap. But that didn't deter her. She would earn and save everything she could in every possible way, despite having no formal education or job. She did whatever she could as a housewife. She would keep student boarders in her house for a fee and take care of them like she did her own kids. This was like Airbnb way back in the day. She saved all the money and spent it very carefully, all the while ensuring that she had enough to compound her savings in a way to pay for her education, or at least some part of it. And where her innate skills as a value investor truly became evident was when she went to the market, which is why I have this photo here. These trips to the market became my bachelor's, master's, and PhD in investing. Because anyone can read books, right? You can read books, you can learn the concepts, you apply formulas and analysis in Excel to try to understand a business, its earnings, P/E ratio, dividend yields, and so on. But ultimately, all great investing is a skill and wisdom you generate in your stomach, not in your mind. And you can learn the basic concepts, but just like with anything else, you need to practice, practice, and practice until you develop a feel for it in your gut, a feel for the drivers, what works, what doesn't work, what drives the business, what drives the stock, because they're sometimes two different things. Now, the market near my house was very similar to the wet markets in Singapore or the bazaars in, say, Thailand, where you have lots of homogeneous merchants all selling the same thing. And not like the supermarkets of today at all. Also, unlike today, you didn't have the internet to get instantaneous pricing at the click of a button, so there was lots of intense negotiation. So when we went to the market, my mom would really do her research, going around the entire market, speaking to all the merchants, eyeing all the merchandise, finding out what's in season, what's off season, because the off season stuff was always more expensive. What was imported, what was local, the various areas of the country that the goods came from, the cost of labor, the cost of farming in these different regions, etc. And this allowed her to know the price, or actually more importantly, the value of everything she needed for the house. Because the price is what any merchant would quote her, right? But the value was what those things were actually worth. And through her years of practice, she knew merchant margins inside out. Nobody could fool her. For us kids, though, all this was a big pain in the butt. Because instead of a quick trip to the supermarket where we just go dump all the items in our basket and go to the counter, every trip with her would amount to an hours-long research expedition. But then, slowly, we started to understand. It was fascinating to see how the same fruit and vegetable can be priced differently by different vendors. How the prices change depending on when you went during the day. If you went at night when the shops were closing, items would be 75% off for the exact same thing that was selling at 3 to 4 times the price that very morning. Now, this may sound silly, but this is very similar to financial markets during very exuberant bull markets or depressed bear markets. Things are always expensive in roaring bull markets and cheap in a deep recession. We understood how when things were in season, they became very cheap, just like durian last year, and when not in season, they became very expensive. In the investing world, we call this fashion appeal. For example, something like artificial intelligence or AI today is very hot, just like Bitcoin, say 2 years ago, and it looks like it's coming back into fashion again now. Things go in and out of fashion in financial markets all the time. But because of my training, even today, I rarely buy into hyped up things when it gets to these very excited, euphoric levels, which typically mean that they're very expensive. And this discipline
discipline has saved me from countless losses over time. Conversely, we always try to buy things with lots of inherent value or margin of safety that's often misunderstood, perhaps because they're not in season or not in fashion, which usually meant that you could buy them very cheap. This is a contrarian mindset which most great investors have. So in the market, the farmers of a certain area were always trying or always willing to negotiate more because they had higher margins than others who have their farms in more urbanized areas. This again is very similar to how stocks and businesses in different countries are valued very differently. To give you a current example, US tech businesses today are far, far more expensive than their Chinese tech counterparts, even though for the most part, the technical abilities and the long-term earnings power of these businesses are quite similar. There are, of course, some nuances which I won't go into right now, but you get the idea. In any case, at the end of our marketing day, we would haul home 2 to 3 weeks worth of groceries at prices that were probably less than half what anyone else was buying at a supermarket chain. My mom was a very smart negotiator. You definitely didn't want to be on the other side of the negotiation. She knew the value of everything. She would always tell us, rule number 1, don't overpay. Rule number 2, don't forget rule number 1. And that's all the rules there are. So my brother and I also learned the tricks of the trade. After several years of going with her, all these lessons became ingrained in our minds and most importantly in our gut. In any case, I know that was a bit of a long story, but there are many valuable takeaways into the investing world that I'll go into now. First, even though my mother was shopping for groceries, what she was ultimately trying to do is find bargains. Basically, to find $1 for 50 cents. With investing, if you buy things far below what they're worth and you buy a bunch of them, it's very difficult to lose money over time. In fact, you'll most likely compound your capital at a rapid pace. This is exactly what both my bosses did to great success, and this is also what I practice today. More than any financial knowledge, what you need is the right temperament, the right attitude for investing. High IQ is not a requirement at all. You just need to be smart enough to do basic primary school arithmetic. You don't need to be very smart with investing, but you do need to have the right attitude. You shouldn't feel differently being with the crowd or against the crowd, buying in season or off season, buying at night or buying during the day. You're not right or wrong because 1,000 people or the entire market says that you're right. You're right because your facts and reasoning say that you're right. Most importantly, you need to have a long-term view. The stock market is not a lottery ticket or a get-rich scheme. Astaghfirullah. If that's what you're trying to do, you'll lose a lot of money. Next slide, please. I see a lot of people thinking about what a stock will do in a few months or 1 year or 2 years and are constantly checking the stock prices and portfolios. This is only going to help one thing go up, either your blood pressure or your spouse's temper. Stocks pay a fortune in the long run, but can be very damaging if you seek quick riches. If you go back in history and study the data from 1870 to today, the odds or probability that the US stock market, because the data is only available for the US, but the takeaways are universal. The US stock market, the probability that the US stock market would be positive on any given day is around 50%. So basically a coin toss. Over a 3-month period, it improves slightly to around 60%. over 1 year, the likelihood goes up to 68%. Over 5 years, the stock market has been higher 80% of the time. Over 10 years, 88% of the time. And over 20-year periods, the stock market was higher almost 100% of the time. So one way to think about this is that there's a most convenient investment time horizon, probably somewhere around 10 years or more. That's the period during which the markets almost always rewards your patience. The more your time horizon compresses, the more you rely on luck and tend to ruin. If you look at all the historic investing blunders people have made, over 90% of them will be because of people trying to compress this naturally most convenient time horizon. It's the same with companies or businesses, which is why we need to think of stocks as owning a piece of a business. That's why they're also called shares. You own a share of a real operating business. It's not just a ticker or financial instrument you see on your screen. It's something you want to own for decades. Just like with your property, right? So when I look for a business to invest, I always try to value the business first and not even look or know the stock price, so that I'm not influenced by the price the market is willing to pay in making my decision. To illustrate what I mean, let's just take the example of property, right? Because that's something, property that most people at least understand the fundamental concepts behind it. So today, all of us know the value of our property, right? For example, we know that in Raffles Place, a piece of land may be worth around $4,000 per square foot. And maybe in Woodlands, it's worth, say, $1,000 PSF. Let's say that there's some guy, and we call him Mr. Market, comes over to your house every day and offers you a price that he's willing to buy or sell your property at in an instant, at every moment in time. Maybe next slide, please. The best part is that this Mr. Market is a bipolar manic depressive, basically a drunken psychopath. Some days he's very happy and will offer you a very high price for your property, or some days he's very upset and offers you a very low price. One day he'll come offer you maybe 5,000 PSF for your property in Woodlands. The next day he'll come and offer you $500 PSF. But the good thing is that you don't have to engage with him. Like when you see a crazy person on the street, you can choose not to pay any attention to him, except when it's in your advantage to do so. Now you'll tell me, Ishwar, that's all well and good, but you're crazy. Nobody will ever come do that with your property. This is true, but this is exactly what happens with the stock market every single day. So while it may not happen with your property, it happens with all the listed companies and businesses on the planet, which is a pretty big asset class that you can participate in. And you can choose when to engage with this Mr. Market. It could be once a year, it could be once in 5 years, or once a decade when he is extremely depressed and offers you a phenomenal bargain. All you have to do is sit patiently and wait to take advantage of it. Let me give you an example from the very recent past. Next slide, please. This is a chart of Facebook, or Meta Holdings as it's now called, over the past 1.5 years. I'm sure we've all used their products, and if you do, you'll know that very little has changed on the Facebook platform as far as the business is concerned. But look at the prices offered by Mr. Market over the past 2 years. The x-axis is the timeline, and the y-axis is the stock price. In 2022, Mr. Market was extremely depressed, and every day he knocked on your door and offered you a lower and lower price. The dark blue line is the stock price, and all the other lines denote various valuation levels of cash flow for the business. So when the stock reached $100 in late 22, the business was valued at less than 5 times cash flow. What this means is that the business will generate its entire value in cash in less than 5 years. That's like saying that your property can be rented for a 20% rental yield with the rent going up every year, because because Meta or Facebook's earnings were also growing. Sounds phenomenal, right? It really was. All you had to do was understand the business, which is not very complicated, trust me, and wait for Mr. Market to offer you this fantastic bargain, and pounce when everyone was pessimistic in late 22. So now, today, that was at $100, late 22. Today, Mr. Market is now offering you 4 times that price and just over a year. So what changed? As far as the business is concerned, absolutely nothing has changed. What's changed is the mood of Mr. Market. So just like this, Mr. Market will continue to throw various opportunities at you every day for the rest of your life. You don't need to swing at every pitch. You wait for the fat, easy pitches that you understand, and you may swing, you may not swing for 5 years. Don't be in a rush. Patience is one of the biggest virtues in investing. Mr. Market is there to serve you and not the other way around. But then people ask me, how do you understand a business or even define its value? Next slide, please. First, you need to play in your circle of competence, what you know and understand, and then find the highest quality businesses selling at the biggest discount to its value within those circles. As I mentioned earlier, you don't need to make money in every game. There are lots of things that we don't know about and shouldn't care about. Focus on the areas that you do know about, where you can have a potential long-term insight that others may not have. I always tell my team that my wife is my retail analyst and my nephews are my tech analysts. So if your hobby is shopping, right, and you travel to Japan, you would have noticed years ago when a chain like Uniqlo was doing things very differently to their competitors in apparel retail. Back then, they only had a few stores in Japan, and management was embarking on a massive global expansion plan. Since then, the stock has gone up at least 10 times over the past 10 years. If you were in the tech space, when the iPhone was first released and understood what a big paradigm shift the technology was and its implications on software, the app economy, the number of devices that computing would reach, the possibilities for global expansion, you could have done very well investing in Apple. This is exactly what my nephew, who was in high school in 2008, did when he saw the iPhone. So once you understand your circles of competence, you need to go back to the concept that a stock is a part of a business. And for any business, its success will be driven by the earnings that business generates over time. Not just this year or not next year, but say over 5 or 10 years and beyond. Because all the professionals are already focused on what's going to happen this year and next, right? It's very rare that us as laymen would have an insight on these very short time frames that they don't already have, and that's not already priced into the stock. But many people, even those very close to the numbers, often miss the forest for the trees when it comes to the long term. Once you understand the earnings trajectory of a business, say over 5 or 10 years, then you need to take a view on the multiple that business is worth. Remember the Facebook example I gave earlier? When the stock fell to $100, late last year or late in 22, the size of the business was 5 times the cash flow the business generated that year. This meant that Mr. Market was saying that this business will not exist beyond 5 years, all other factors held equal. So in the Facebook example, say you were in the advertising business, right, and saw ad budgets actually increasing on Facebook, or had a small business and could see very high conversion rates on your ads on Instagram, or your client engagement on WhatsApp, or you were a gamer and had a strong view on their metaverse initiatives, you could easily see that this business is going to be around and thriving for at least the next 10 years. Management was also embarking on a big cost-cutting plan, which meant that earnings will also go up in the near term. So this 5 times was a ridiculous bargain. What's more, the company also realized this and started buying back a lot of their own stock, which is usually a very positive sign on management's confidence in their own business. Then, if you took the next step and looked into their quarterly or annual reports, which are available for everyone for free, usually on the company's websites, you would have realized that there's no way that Facebook will go out of business in 5 years. Of course, inshallah. So then what's the right multiple, right? Maybe it's not 5 times. Is it 10 times? Maybe it's 15 times. And that's where the stock is trading at today, at 15 times. But how do you know that things would pan out this way? We don't. The more, everything is perfect in hindsight, right? When we know all the facts after they've happened. But remember what I told you earlier, that investing is not a game of the mind. What's the most important part? It's your stomach, right? Your judgment. And this piece you only get through practice and more practice. And the more you practice, the more you'll realize maybe a fast-growing or dominant tech business is worth at least 15 times its cash flow. Maybe a slow-growing or mature business is worth 10 to 15 times, and so on. You'll understand, or at least get a feel for what ranges make sense for the different type of businesses. So this also means that you need to understand what type of business you're investing in. Like if you're investing in a commodity business like copper or oil and gas, you need to understand that the earnings of these businesses go up or down based on things like economic growth, new supply, or demand from big customers like China, for example, which is a big consumer of both. And those kinds of businesses' earnings move in cycles like a wave. So that would be a different style of investing. You need to buy at the bottom of the cycle and sell close to the top of the cycle. Then there are, of course, bellwether stocks that are large blue chip companies of any sector. Say, for example, Roche or Johnson & Johnson in healthcare, Honeywell or Airbus in industrials, Shell or Total in energy, and so on. These are all big companies that won't necessarily grow very fast, but they'll generate steady earnings, and they may pay very high dividends if that's what you want. They're also generally well managed, so you know your money is in safe hands. These companies may deserve lower multiples than, say, a fast-growing tech company that's very fashionable in the market today. It's just a different style and risk profile for investing. In any case, once you buy a business, as long as the earnings keep growing and the business is being managed by good, competent and honest leaders, you don't really need to sell. Unless, of course, what happens? That Mr. Market becomes delirious again and offers you an insane price that you simply can't, or should I say, shouldn't refuse. Just like with a good property, if you purchased a property in a nice developing area that originally had nothing around it, you probably had the view that there's going to be lots of amenities that will come next to it and make that area far more livable and rentable and valuable, right? So maybe there's going to be a new highway exit, a new MRT station, a new mall, perhaps there's a beautiful park being developed a few meters down. All these will increase the rental potential of your property, right? It's very similar with businesses. If the business can keep growing its earnings and it's not exorbitantly priced, then you can own it for the long term. The most important thing you need to do is to sit down and think very deeply about how earnings of a business can evolve over time. You know, I laugh sometimes because we put so much thought into buying simple things, like a TV, a computer, phone, a fridge. You compare the RAM, screen size, processor efficiency, blah blah. You read reviews, you go see the item, you wait for the coupons, and you finally make the purchase after tons of due diligence. But when it comes to stocks, I've seen people bet their life savings on a tip they hear in the bus, So we need to do our research and give it the thought that it deserves, because we're playing with our savings and our families' well-being, longer term. So we need to think about stocks and businesses at a deep level, and we need to practice this. As with everything, we'll only get better with time. I also mentioned quality businesses here. What I mean by this is a business with an enduring competitive advantage. You need a business with some kind of a moat around it that competitors can't eat into. Because say, hypothetically, you have a restaurant business, right? Anyone can come in, steal your chef, open another restaurant across the street, offer the exact same food at half the price, and ruin your business. So a single unit restaurant is not a defensible business. But say you think about a company like Microsoft or Google, right? Even if someone gave an entrepreneur billions of dollars, they would never be able to disrupt the Windows operating system or Google search, at least not over any time frame that matters. These platforms and companies are so entrenched and sticky. Many have tried to disrupt them and displace them, but they've all failed. So those are examples of businesses with very strong moats and competitive advantages. There are many types of moats. Maybe it's a patent, maybe it's a location advantage, perhaps it's an install base, network effects, maybe it's scale, and you can make something cheaper than everyone else because of the scale. Maybe it's a process, maybe it's a brand. There are many types of moats that define quality businesses, and you can look them up online. There's a lot of literature out there on them. And finally, you want a business run by honest and able people. But sometimes the best businesses are the ones that have such a strong moat and are so good that you could even have a dope running it and it will still do well. So this Peter Lynch, this famous fund manager, had this saying that you must buy a business that's so good that even an idiot can run it, because sooner or later one will. And there's lots of truth to that, Again, you can think about companies like Microsoft and Apple, which are the most successful companies you can think of today. Both of them went through spurts where very poor management ran them. And those periods were the buying opportunities of a lifetime, after which Satya Nadella guided Microsoft to new glory and Steve Jobs guided Apple to glory. Now I know all this is a lot and sounds very complicated, but it's really not. And you just need to practice. Next slide, please. There are different styles of investing too. So some people like investing in fast-growing companies, some people like dirt cheap companies, some like to invest thematically, and some like to invest in certain geographies. It depends on what you want, what resonates with you, your temperament, and your capital needs. There's no right or wrong style. But the more you practice, the more a certain style will probably resonate with you. Do what's in your circles of competence and what you feel will work for you based on your practice. The beauty about the stock market is that there's something for everyone. Also, you don't need 100 ideas. If you have just 5 great companies your entire life and keep investing in them as they compound, you will do very well, inshallah. Also, with diversification, lots of people believe that you should diversify by owning many stocks or businesses. While this may be true with an index, on a personal level, what we need to strive for is to diversify by economic factor exposure, so that even if one factor is not doing well, another factor may offset those losses over any given period. So if you have 12 to 15 uncorrelated exposures, that's all you need to outperform the indexes, provided you did your research right. Also, there are only so many businesses you can understand at deep level, so 12 to 15 is ample. But try to mix it up. For example, say a technology business will have a very low correlation with a hospital chain or a utility or a travel company. So construct your portfolios so that no matter what the overall macroeconomic conditions are, your portfolio outperforms. The diversification can also be geographic, by sector or by theme. For example, during COVID, the travel sector did very poorly, but hospitals, healthcare and tech performed exceptionally well. And you'll have these types of offsetting exposures through all economic cycles. Now last but not least, next slide please. We need to ensure that the businesses we own are halal and Sharia compliant. I won't go into the details around the Sharia criteria because that's not the scope of this discussion, and will probably be better covered by my esteemed colleagues who follow in greater detail. But needless to say, whatever businesses you're investing in need to be halal. The Sharia criteria permits up to 5% of earnings in businesses that are non-compliant. There are also 3 financial ratios that need to be adhered to. These vary a bit by different indexes or schools of thought, but broadly speaking, the business can't have too much cash that's seen as being invested in the bank and accumulating interest. It can't have too much debt and can't have too much receivables and cash, which again leads to interest. You can easily pull these numbers for any business from their annual reports, which again are free on their websites, and then put the numbers into Excel and monitor the ratios as the businesses evolve. I'm sure in the near future, with things like ChatGPT spreading to finance, you'll simply be able to ask an app or a stock app if a stock is compliant, and it should be able to give you the answer in the near future. Next slide, please. So how do you start if you have no clue? Really, you just need to start reading and digging into sectors, industries and markets that interest you. Subscribe to a publication like the Financial Times or Barron's and start getting a feel for investing and its various drivers. There's also tons of free or very low cost resources online like Seeking Alpha or even Twitter, or X as it's now called, where there's tremendous free discussion around all types of industries, businesses and investments. I've also suggested some interesting books that will go deeper into some of the concepts I've talked about. I know most of us don't like things that are too technical, so don't worry. All these books are very easy reads and have profound lessons, inshallah, promise. So please, all you need to do is just get started. To finish first, you must first finish. And most importantly, as with everything in life, in this dunya, tawakkaltu ala Allah. Next slide, please. We can't expect miracles to happen if you don't put in the effort. Start with Bismillah, have the right niyyah, put in the work, develop your experience, skills and judgment, and leave the rest to Allah. Remember, I started with the story of my mom and how she did everything she could to save and invest for our education. she was a great example of tawakkul. With all her efforts with value marketing and everything else, she ended up saving a bit of money for my brother and I, but it was only enough for just 1 year, for one child. If we were to study in America, where my dad's brother lived. So my mom got ready to sell our home that she inherited from her parents to make up the rest. So at least she could send me, and then I could sponsor my brother. But Alhamdulillah, Allah is the best of planners. Both my brother and I ended up getting full scholarships to study in the US, and my mom got to keep both her savings and her house. So tawakkul is essential. I don't know, maybe it was also the du'as of my father's free clients. Anyway, thank you for coming and listening to me so patiently. I hope this was beneficial to you. Whatever good I said comes from Allah, and any mistakes are mine alone. I'm also learning just like all of you. If there's anything I can do to help or guide you, my personal email is at the bottom of the slide. I'd be glad to help in any way I can, inshallah. Don't worry. Just like my father, my assistance and help will always be free. Jazakallah khair. Assalamu alaikum wa rahmatullahi wa barakatuh. I'm happy to take any questions. There are. There are mine. I can repeat the question. Can I ask you a question? The question was, I manage a Sharia compliant fund, and the returns in investing in that type of fund as opposed to doing it yourself, is it? Well, I'd say it varies by the manager of each fund, and it's also not just the fund, but the style of the manager, what they're looking for, what you're looking for. There are various funds with very different objectives. Some funds that are, again, as I alluded to in terms of the styles, growth-focused funds, value-focused funds, dividend income funds. So each fund would provide you a different return and risk profile. So our fund, the fund I manage, is a global equity fund, and my style personally is a mix of all styles. So I don't gravitate to it. So it's I would say and our fund in the last 3 years, which have been quite volatile, has done around 7% a year for the last 3 years. But if you look at the benchmarks, that's done around 6%. That's the benchmarks constructed by the financial that track the Sharia equity market. So I'd say you have to go and meet each of the fund managers that manage these funds and just understand how they invest, and if it resonates with you and your style and what you want. But the returns can vary quite wildly, and it also depends on the time period as well. That's why you need at least 10 years, to have a proper track record. So even mine's quite short, at 3 years. Maybe address the first question first because it's topical. So Microsoft, okay, I'll go to the first one. So in terms of these companies that that have dubious links and involvement against the Muslims, right? I mean, my view is that, I mean, you have thousands and thousands of companies in the world, right? And if there's any company or business that even has a slight link or inclination to oppressing Muslims anywhere in the world, then why bother, you know? That's a gray area. Maybe they're great companies, maybe they're doing phenomenally well, but then there are 1,000 other great companies that you can find that are doing just as well, or if not better, that you can invest in. So instead of having, Starbucks or McDonald's, you can look for another food chain if that's what you want to invest in. Or on the technology side, there are a lot of companies, there are industrial companies, oil and gas companies. None of them have any involvement, even if there are dubious links. So yeah, I would just, because this is not something that we can justify. This is between us and Allah, right? So I would tread carefully, and if there's any alternative, then choose that. And why even bother? Unless they come out there and say it. You can even ask them. You can. What I do is with these companies, I message them or I email them and ask them, like, where do you stand with this issue? You know, and they have to give you an answer, right? That's a clear-cut stand with, say, Israel or Palestine or the Chinese or the Rohingya, or whatever it is. If they have no answer, then you can avoid. You know, why stray down that gray area? Microsoft. The second question was Microsoft not being halal. So the thing with the Sharia criteria, I mean, it differs. So Microsoft is halal according to the MSCI criteria check, which is the criteria that I had on my slides. And maybe so the other criteria. So each of the indexes, that criteria differs slightly. So I'm not sure if it's not compliant on them, but in the MSCI Sharia benchmark, it's the biggest position by far, 17%. So according to that, it is compliant. And I think if you just need to pick one framework for measuring the criteria, and then stick to that. You know, so like say Microsoft qualifies under the MSCI criteria but doesn't qualify, say, under the FTSE criteria, you can't, I wouldn't flip-flop between one or the other depending on what's most convenient to you. You know, you pick one school of thought, stick to it, and if Microsoft's not compliant by that criteria, then avoid it by all means if that's what resonates with you, because ultimately we're trying to do what's best by the Sharia. So as long as your niyyah is correct, follow that. Very top, new to this, any apps where we can do our investments? Yes, I mean, so if you're investing in stocks, you can do it through Interactive Brokers. That's the easiest way to do it, the lowest cost way, where we can pick our own stocks and just buy them. And within that platform, there's also ETFs that you can invest in. That is basically the index, say like the S&P 500, the different index providers will have a bunch of companies that form their global equity index or an Asia index, and you can buy those through a platform like Interactive Brokers as well. But there are also now growing Islamic platforms, you know, like I know there's Wahid in the US, they also have some presence here. I don't know if you can, they're set up yet, but I'm sure it'll come soon. And then there's Islamic Finance Guru in the UK. And, you know, I know Ridwan and them are working on RiskX as well here. So, yeah, there are a few already, but I'm sure there'll be a whole lot more in the coming years. But even use them, I would definitely start learning and understanding how all these things work, you know, because that will help you through your journey over time. the first question again on top, we're investing to grow our monies and buying stock, expecting it to grow. Isn't that gambling? So I would say it's all about doing the deep work and your time frame, because as I said, if you try to compress the time frame into 1 year, 2 years, and you're just buying stocks without doing any work, expecting it to go up, then I would say that's more similar to gambling. But if you're doing the research, right, if you're putting in the work to understand the business and the earnings and what this company is going to do over say 10 years, that's like the work you would put into starting your own business, right? Like you look at the fundamentals, say you're starting a shop, you're trying to understand all the key drivers, so and you're investing for the long term, and you're investing in it based on the earnings. So it's a calculated investment. So if you do it that way, then again it's all depends on the niyyah. Then I wouldn't say that it's gambling. It's based on study, research, and underlying fundamentals. But if you're trying to make 20% in one day and put money today to get it out tomorrow, then yes, that would be more in the gambling camp. So just one company, a must invest stock as a beginner. What I would say, I won't give you one stock, but what I will say is where I'm finding a lot of value today is in China, because, and the reason being that Mr. Market is extremely depressed on China or in China. So he's coming every day offering me your 1000 PSF house for 100, 200 PSF today in China. So that's where I find a ton of opportunities currently, and that's where our funds are very heavily invested in. Of course, I mean, there are also issues, there's geopolitical issues, there are trade issues, the US is trying to crimp China's growth and development, but the underlying businesses, management teams, and the overall economic structure is very favorable, and lots of the companies are extremely cheap. So I would look into China and the China tech space in particular, especially if you compare the tech businesses and their earnings in China versus the US. You'll see like one is, using those cash flow examples, one is say at 100 times, and in China it's at 3 times, so like there's a huge gap. In terms of money management, what percentage of salary should we invest? Well, again, it's subjective and depends on your risk tolerance and what you want out of life, But in general, if someone's not a stock specialist, what I tell them all is like you should start, at least at the early stages, start investing with as much money as you're willing to lose, So use that as tuition fees. And even if it's, so I'd say of your monthly salary, right? So even if you could, of your savings, if you could set aside, say 20%, 10%, 20%, and start with stocks. And as you get more comfortable analyzing industries, businesses, sectors, then you can increase it. So for someone like me, I'm 100% in only stocks, because that's what I know, that's what I understand, that's what I enjoy. The beauty about stocks over any other investment class is that there's very low cost, You can buy and sell at the click of a button, right? So with real estate, you have to go get lawyers, pay stamp duty, you buy, it's 4%, whatever it is, 2-3%, to sell 2-3%, and then there's lawyers, so much involvement, and even to execute a transaction, you can't. That's why it's very difficult. To buy and sell, you hold these properties for decades, right? Whereas with the stocks, you can buy in an instant, you can sell in an instant, because sometimes we get it wrong, right? So we buy a stock thinking that this is going to happen, and it doesn't happen. Then we can always sell and buy something better that we feel can compound greater value over time. can't go into compounding interest, that's right, because it's not, so Sharia compound way of compounding. I mean, what I use compounding as is growing your wealth, right? So, say you have $100, you grow that by 33% a year for say 3 years, you've tripled your money in 3 years. So when I mentioned my bosses who had compounded sort of 30% over 30 years and so on, I meant compounding your capital as opposed to, I didn't mean compound interest per se. But yeah, and you can compound your capital through your investments in businesses and companies and not only through interest. Yeah, so the first, the question at the top, I would say it's a question for a Sharia scholar, so I'll leave that as is. Day trading on the stock market, is it gambling? I would say yes. If you're day trading not based on long-term earnings or fundamentals, it would be gambling, yeah. Insights on Forex, I have very little, to be honest. So I just study businesses and industries and sectors. Forex is not my forte. The investment strategy as a fund manager differ from a personal investor. The underlying fundamentals are not too different. Where I would say it is different is the portfolio construction. So as an individual, I can take very concentrated bets in businesses that I know and understand, right? And so I can even have 2 positions, 5 positions, 10 positions as a personal investor. But as a fund manager, I can't do that because I'm not managing money for just one person, right? I'm managing money for a whole lot of people. And I need to have that economic sector diversification. So a fund manager's portfolio would probably have far more stocks. It would be diversified by more sectors. It would be more heavily in countries that are in the benchmarks, say like the United States. Whereas as a person, so for me personally, my fund positioning is very different from my personal. My fund positioning is very diversified across sectors. My personal positioning, 100% China tech. So you could, yeah, that's basically follow what resonates with you. So what categories of business sectors is a more assuring? I mean, it's just go back to think about the type of business that people are partaking in. You know? So if it's an oil and gas company or a copper, like commodity producers, those kinds of things, there's very little doubt on if selling oil, unless you're selling oil in Israel or like an Israeli company selling oil, then that's obviously dubious. But those are very easy to distinguish whether it's halal or not. With tech companies, it's a bit subjective as well in terms of the business activities. Like there are some companies, I mean, I don't want to go down this rabbit hole, but I think what you need to do is think of the underlying root business. So say if it's a food company, right? Say McDonald's, Starbucks, or whatever it is. If like all the food that they're selling is halal, we don't know that, right? So those are a bit more dubious to judge. Whereas say industrial company that's building factories, building aeroplanes, building widgets, microchips, like semiconductor companies, those are very easy because they are providing technology tools, maybe commodities, that there's no doubt at all in terms of the business activity. It was the same. Yeah, so the intrinsic value, how do you determine the intrinsic value of a company apart from looking at the price to book PE ratios? So, the intrinsic value is what a company is worth, right? So that again, as I said, it comes through like reading a lot, looking at many companies, looking at many businesses, and practicing the art, because and it's not the intrinsic value today that you need to think about. You need to think about the intrinsic value in, say, 5 years, 10 years, and beyond. Because the intrinsic value today will be slightly different from the market price, so you're playing for 20, but over, say, 10 years, say, for example, Alibaba, right, in China, the e-commerce platform there, the business today is valued at, say, 4 times free cash flow. And it used to be valued at 20 times free cash flow when it was growing very fast, and now it's been slowing. China's been slowing, so as a result, it's much cheaper. So then, what's the value, right? And the value is what the market is willing to pay for it at some point in the future. And so, say, then you need to make these assumptions, right? Like, say, China recovers. Say Alibaba's growth picks up. Say their cloud business starts doing very well again. So then will it still be 3 times? So maybe then it could be 6, 7, 8 times. Maybe it could be 50, go back to 15 times if China starts booming again. Maybe the US geopolitics easing. So there's no, I wouldn't say there's like one fixed answer for intrinsic value. It's just a range of outcomes that you need to think about, and most importantly, it needs to be thought in the context of the current stock price. So that's what I would focus on.
Okay, excuse me. I think we have time for one last question. So I would like to prioritize someone from the audience who likes to ask their question live. Is there anyone with a very burning question that you want to ask our speaker? Otherwise, then I'll let Ishraf. No, that's it. Okay, thank you so much.
Yeah, thank you. Thank you very much.
Okay, I would like to call upon Muhammad Ridwan, Managing Director of Islamic Finance Singapore, to present a token of appreciation to Ishraf Hassan.